110, the modified adjusted gross income tax requirement is eliminated. That's the one that says how much money do you make in order to qualify for a Roth. That's great. The requirement that married individuals file jointly is eliminated. So if you want to file your return separately and you have a Roth, you can do that because it may make tax sense to do that. And you can include the 10,000 conversion in your income in 2010 or spread the 2010 taxes over 2 years, 50-50, okay? Half and half. Okay, and your election is made on your 2010 tax return. When you file your 2000 tax return, you got to make sure that how you're going to elect to treat this conversion. Yes, sir?
You just said that, and it's subject to tax in 2011 and 12, correct? The rates in those years.
In those years.
Could be higher.
It could be higher, right. But it's 50-50, so it isn't this year into 2 years, except on a 50-50 basis.
So 2010, it could be cheaper.
It could be cheaper.
Cost.
Correct.
Depends on the probability.
See that young man over there?
Me?
Either one of you.
Yeah, okay.
Yes, sir.
I have a question. My accountant said, our accountant said that it doesn't pay for me to get have a Roth because of my age, and also that because my tax, we pay the highest tax bracket, that then this would even add to my taxes that doesn't pay.
It could very well be true.
So there's if a person, let's say, is in the highest tax bracket or close to it, and then it would bump them up to the next bracket. Does it actually pay for them to have a Roth?
You know, I can't comment on that at all because each situation is so different these days. It really depends on the facts and circumstances at the time. I could see myself paying 50% tax and not worrying about it. If I have in a market or I'm smart and doing kinds of things that Bruce is talking about, that 50% tax is irrelevant. I could see a scenario where that may be true, depending on what my investment is. Because it may be appreciating or the return may be so tremendous that 50% is just the cost of doing business. Again, I don't know what those situations are.
But if he's all still making income, actual income, and he has his own business per se, and he does the SEP, and the SEP goes into the IRA. The IRA can go to your grandchildren.
Yep.
Can't you do so?
Absolutely.
Therefore, there is ways that it would fit.
Absolutely. There are a lot of ways it would benefit, but I just don't know what to say about the individual tax situation. The inheritance rules can be really advantageous. It depends on what you want to do, what your goals and objectives are over the short term and long term. 70.5, if you have a Roth, you don't have to take distributions if you don't want to, for example. And that may be a great tax planning device. I don't know. And as just gentleman just said, you know, there may be other alternatives, other things that you want to do on a longer term basis. It really, really depends.